channel. I'm Doris. I'm here to show us about my market update. U.S. Treasury Secretary Janet Yellen said that selling talks are making progress. Bank of America's the recession and the credit crunch could lead to nearly $1 trillion in corporate bonds. Yellen, who has made headlines about the risk of a U.S. default, has some good news. In an interview after a meeting of G7 Treasury ministers and central bank governors, Treasury Secretary Janet Yellen said on Saturday that the Biden administration and congressional Republicans are making progress and believe a deal will eventually be negotiated. There was $88 billion left in a balance of special measures used to pay government bills, up from $110 billion. According to Treasury documents disclosed a week ago on Friday, this is also the most direct fiscal figure on the U.S. Treasury default X day. Biden, who met at the White House earlier this week to discuss the debt ceiling, was scheduled to meet again on Friday, but the meeting has been postponed until the next week. Yellen explained on Saturday, "My understanding of the delay is that the negotiations are making some progress, and the two sides want to have something practical to talk about when they meet again, which is good news to me." Democrats, who has previously stressed unconditional debt ceiling increases, have also softened up and may accept restrictions on the federal government spending. According to people familiar with the matter, some Democrats also believe that the spending limits that are flexible enough will gain party support and open the door to negotiations with Republicans. One point of contention is the durability of the spending limit. Democrats want the spending limit to last for only 2 years, but Republicans want something longer. In a bill passed unilaterally last month, the bill limit was set at 10 years. There is a background here too. Since Republicans control the House, any spending over the next 2 years will need their consent. There are also differences between two sides over how to reuse the nearly $70 billion surplus of the pandemic response. Some Biden administration officials also expect Congress to pass a short bill to raise the debt ceiling if the two sides fail to reach a deal in the coming weeks. Delaying negotiations to the summer and even fall is also more in line with Congress's usual budget approval schedule. It is worth noting that the only time left for Biden to negotiate with the Republicans next week is Monday and Tuesday. A White House spokesman on Friday said that Biden still expects to travel to Japan for G7 Leaders Summit next Wednesday. So far, according to the schedule, Biden will also visit Papua New Guinea next Wednesday weekend to hold a U.S. Oceania National Summit. In other words, if the exact outcome is not achieved in the first 2 days of the next week, the whole story of the U.S. debt default crisis is likely to continue. Bank of America, recession and credit crunch could lead to a nearly $1 trillion in corporate bonds. The effect of the recent recession and credit crunch could eventually. We haven't had a normal credit cycle for a long time, Bank of America strategist Oleg Malenyatev said in a letter to customers on Friday. He was referring to the credit cycles that began in 1981, 2000, and 2007. These cycles were disrupted by sharp tightening of credit conditions, causing the 3-year default rate of U.S. corporate defaults to soar to around 15%. He said that as the U.S. economy approaches recession and the credit crunch, the 15% corporate defaults rate is a clear risk, though he believes that the coming credit crunch may not be as severe as it was during the first big financial crisis. We think it is reasonable to think that the next 3-year default cycle, whenever it begins, should add up to be a lower peak, he said. In a full-blown recession, there is amount to an 8% corporate default rate, potentially leading to a $920 billion default on corporate debt. This is largely because banks have tightened credit conditions since the collapse of SVB. Debt growth has also eased in the recent years, while the Bank of America strategist said a modest recession is possible this quarter. Officials have yet to announce a full recession. If general recession does not come in the next year or two, the cycle will be delayed, but it will not be cancelled for now. we still believe that a moderate short-term recession is more likely than a full-blown recession in the foreseeable future. Therefore, we think the accumulation of losses is already proceeding at a moderate rate, but it has not yet reached the takeoff point that brings our default rate to 8% of all total credit. The outlook for a future recession is becoming increasingly tight, with the New York Fed's index predicting a 68% chance of a recession coming in April 2024. The risk stems from the Fed's aggressive rise in the interest rate over the past year to curb inflation. Recent banking turmoil has exacerbated this risk as banks have to withstand losses on bond portfolios and a sharp flight of deposits, tightening new lending. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.